The world of options trading can seem complex and even daunting for new investors. However, amidst the jargon and intricate strategies, there lies a fascinating instrument known as the long iron butterfly. This strategy, while carrying a slightly intimidating name, is surprisingly straightforward in its approach, and particularly appealing for investors seeking steady income in a sideways moving market. Unlike traditional stock trading, where profits hinge on price direction, the iron butterfly thrives on stability. It allows investors to capitalize on their market view, specifically the prediction that a stock's price will remain range-bound over a certain period. Imagine the stock market as a tranquil pond, with the price of a stock like a lily pad bobbing gently within a confined area. This is the ideal environment for the long iron butterfly to spread its wings and generate potential profits. In this guide, we will demystify the long iron butterfly strategy, breaking it down step by step and demonstrating how it can be employed to potentially generate income in a neutral market. Join me as we delve into this intriguing world, using real-world examples to illustrate its mechanics and highlight its potential rewards. The iron butterfly strategy isn't for thrill seekers chasing explosive profits. It's a strategy designed for prudence, best suited for markets characterized by low volatility and range-bound price action. Think of it as sailing calmly across a still lake rather than navigating a stormy sea. Volatility, in financial terms, refers to the degree of price fluctuation for a given security. High volatility signifies dramatic price swings, while low volatility suggests a more stable, predictable price range. The iron butterfly flourishes in the latter environment. Why? Because the strategy's profitability hinges on the underlying asset's price remaining within a defined range. Large, unexpected price movements can erode potential profits and even lead to losses. Therefore, before even considering the iron butterfly, it's crucial to identify a stock or index with a relatively stable price history and a neutral outlook. This means anticipating that the asset's price will likely remain within a defined range, neither skyrocketing nor plummeting during the strategy's lifespan. In the next section, we'll delve deeper into the risk and reward dynamics of the iron butterfly, further solidifying your understanding of why this strategy is best suited for calm, predictable markets. The allure of the iron butterfly lies in its defined risk profile. Unlike some option strategies where potential losses can be unlimited, the iron butterfly caps both potential profits and losses. This makes it an attractive proposition for investors prioritizing capital preservation and seeking consistent, albeit moderate, returns. Think of it as a carefully constructed box. Your maximum potential profit is limited by the ceiling of the box, while your maximum potential loss is confined to the floor. While this structure limits the possibility of windfall gains, it offers a crucial safety net, especially in uncertain markets. This trade-off between risk and reward is central to the iron butterfly's appeal. It's a strategy for the pragmatic investor, content with steady income generation rather than chasing speculative home runs. Remember, in the world of investing, there's no such thing as a free lunch. The iron butterfly's limited risk comes at the price of capped profit potential. Understanding this fundamental trade-off is crucial before venturing into the world of this intriguing strategy. Building your butterfly. A step-by-step guide with Shell. Let's bring the iron butterfly to life using a real-world example. Shell, the multinational oil and gas giant. This strategy can be particularly effective when you anticipate minimal movement in the stock price. Imagine you believe Shell's stock price will remain relatively stable over the next month. This stability is crucial for the iron butterfly strategy to work effectively. You could employ the iron butterfly strategy to potentially profit from this market view. This involves a combination of selling and buying call and put options. Here's how you would construct the trade. It's a multi-step process that requires careful planning and execution. First, sell one call option with a strike price slightly above the current stock price. This is your initial step in setting up the iron butterfly. This means you're obligated to sell 100 shares of Shell at the strike price if the option buyer exercises their right. It's a commitment that comes with its own set of risks and rewards. Next, simultaneously, you'd sell one put option with a strike price slightly below the current stock price. This balances your position and adds another layer to your strategy. This obligates you to buy 100 shares of Shell at the strike price if the put option buyer exercises. It's a crucial part of the iron butterfly setup. Then, to limit potential losses, you'd buy one out-of-the-money call option with a strike price even further above the first call option's strike price. This acts as a safety net. Finally, you'd buy one out-of-the-money put option with a strike price even further below the first put option's strike price. This completes your iron butterfly. By strategically combining these four options with different strike prices and expiration dates, you create the wings of your iron butterfly. This strategy can help you manage risk while aiming for potential profit in a stable market. Watch monitoring your iron butterfly position. Once your iron butterfly is established, your work isn't done. This is just the beginning of an ongoing process. Active monitoring is crucial to ensure the trade is performing as expected and to manage any potential risks. Without regular oversight, you might miss critical changes in the market. Think of it like tending to a garden. Just as a garden needs constant care, so does your iron butterfly position. You wouldn't simply plant seeds and walk away hoping for the best. You'd nurture them to ensure they grow. You'd water them, provide sunlight, and keep a watchful eye out for pests or diseases. Similarly, your iron butterfly needs regular attention. Consistently monitoring your iron butterfly position involves several key activities. First, tracking the underlying asset's price. This is fundamental to understanding how your position is performing. Regularly check Shell's stock price to see if it remains within your desired range. If it moves outside this range, you may need to take action. Significant price movements might require adjustments to your strategy. Second, observing volatility changes is equally important. Keep an eye on Shell's implied volatility, a measure of expected price fluctuations. This can give you insights into market sentiment. Rising volatility could impact your potential profits, while decreasing volatility might present opportunities to adjust your position. Third, managing risk is crucial. Utilize stop-loss orders or other risk management tools to protect your capital if the trade moves against you. This can help you avoid significant losses. Don't be afraid to exit the position early if losses exceed your predetermined risk tolerance. It's better to cut losses early than to hold on and risk more. Remember, even the most well-constructed iron butterfly requires consistent attention. Regular monitoring can make the difference between a successful trade and a losing one. Active monitoring and timely adjustments are key to maximizing potential profits and minimizing potential losses. Stay vigilant and proactive to ensure the best outcomes for your trades. Knowing when to fly exit strategies for maximum profit. Just as crucial as entering an iron butterfly trade is knowing when to exit. A well-timed exit can be the difference between a profitable trade and a significant loss. Having a well-defined exit strategy is paramount to securing profits and mitigating potential losses. Without a clear plan, you might find yourself reacting emotionally to market movements, which can be detrimental. There are several scenarios in which you might consider closing your iron butterfly position, each with its own set of considerations and potential outcomes. First, as the expiration date approaches, if Shell's stock price remains within your desired range, consider closing the position to secure the maximum profit, which is the net premium received when you entered the trade. This ensures you lock in gains without exposing yourself to last-minute market volatility. Second, if your desired profit level is achieved before the expiration date, you might choose to close the position early, locking in your gains rather than risking potential market reversals. This proactive approach can help you stay ahead of sudden market shifts. Third, if Shell's stock price moves significantly against your position, triggering your predetermined stop-loss order, it's generally advisable to exit the trade to limit potential losses. This helps in preserving your capital for future opportunities. Fourth, A sudden increase in Shell's implied volatility can erode potential profits. High volatility can lead to unpredictable price swings, making it harder to maintain a profitable position. If volatility rises beyond your comfort level, closing the position might be prudent. This can help you avoid unexpected losses due to rapid market changes. Remember, there's no one-size-fits-all approach to exiting an iron butterfly. Each trader's situation is unique, and flexibility is key. Some traders like to unwind their position leg by leg. The optimal exit strategy will vary depending on your individual risk tolerance, profit goals, and evolving market conditions. Always stay informed and be ready to adapt your strategy as needed. Thank you for watching, and do not forget to like and subscribe. See you next time.